Alrighty, I think we've reached critical mass, so we are going to go ahead and get started. Thanks again to everyone for taking time out of your day to join us. Just a few housekeeping notes before we proceed. This session is being recorded, and everyone will receive a copy of that recording. So if you have to step away or get distracted at any point in time, not to worry. Again, this entire session will be recorded, and you will receive that copy in addition to other informational materials and resources to help you get started. That being said, if you do have any questions throughout today's presentation, I encourage you to put those in the Q&A. I'm joined by two incredible colleagues of mine, Khadijah Westmoreland and Joe McDermott. They are both student loan experts who work with borrowers each and every day, and they are part of our borrower advocacy team, which means they are looking out for you, the borrower, to protect and advocate on your behalf and make sure that each and every one of you achieves the best outcome possible. So they will be joining me here for the next hour to help ensure that all of you get the most out of today's session. And then the last thing here is that if you need to enable closed captioning or live transcription during the webinar, we'll be posting a link in the chat with instructions on how to enable this feature on Zoom. All right, so my name is Lindsay Clark. I'm the Chief Borrower Advocate here at Savi. I've been with Savi since it was founded back in 2017, and I'm a student loan borrower myself. I have a little over $200,000 in student loan debt. I say that because if it makes any of you feel better about your own situations, then mission accomplished right off the bat. But really because being a borrower impacts how I communicate about these topics. I know firsthand how overwhelming, complicated, and confusing these programs can be because I experienced it myself. And so my goal here today is not to simply talk at you, but it is to help you to understand these programs in a new and better way, in a way that's going to empower you to take action going forward and make it clear what that best path forward looks like. My goal is really to have you leave here feeling better than when you arrived, all right? And that's the commitment I'm going to make to each and every one of you. So again, my goal is going to be to distill this information in a way that maybe for some of you, it's the first time that it actually makes sense, and that these topics are something that you can digest and understand. And again, going forward, you have the entire Savi team and access to the tools and resources to support you to getting to that finish line. Now, I work for a company called Savi. Savi is a social impact technology startup that's based in Washington, D.C. And we were founded by student loan experts and advocates who've been fighting on behalf of the borrower for more than a decade. And in 2017, this was the first year that borrowers could start applying for a program called Public Service Loan Forgiveness. And we're going to talk more about that program in just a bit. But all to say that hundreds of thousands of borrowers applied and 99% were rejected for one technicality or another. And we saw this happen and decided to do something about it. So we developed Savi as a technology platform and a human service to help borrowers like you and like me not only better understand our student loans, but to navigate successfully from start to finish around some of these really complicated government programs. But along the way, our goal is to make the experience of being a student loan borrower a better one, because I think we can all agree it's not great. So we try to do that by identifying as much additional savings as possible on a month-to-month basis through things like income-driven repayment plans. At Savi, we like to think that borrowers, not their student loan debt, are our top priority. There are a lot of entities and companies in this space that are there to serve your student loan debt. They make money off of your student loan debt. That's where their interests lie. At Savi, we are here to serve you, the borrower, okay? We like to think of it as a borrower-first mentality. And you'll get a chance to see firsthand today what I really mean by that. Which brings us to why we are here today, because Savi has partnered with AARP to provide the AARP community with access to the Savi tools, resources, and expertise as an exclusive student loan benefit. So not just anyone can access Savi. It's not available direct to all consumers. It is something that is only provided through partnerships exclusively to certain communities of borrowers, because we really feel that it's the best way for us to have a trusted messenger like AARP to be able to reach as many student loan borrowers within that community as possible. So you all, as part of AARP, have access to this benefit, but not just you, your family members as well. I know firsthand, as I like to say, that student debt runs in families. I have student loans in addition to my brother, my dad, and my grandfather, who was a co-signer on one of my loans. All right, so I know that this is something that likely impacts not just you, but those that are close to you. And the great part about this is, again, this benefit is available to you and your family members. Savi works with some incredible organizations across the country. You can see a few here on your screen. And our goal is to partner with these organizations to help members of their community achieve the best outcomes on their student loans. So with that said, introductions out of the way, we can dive right into the meat of the presentation. And this is really going to be about understanding your federal student loans, the basics, kind of like Student Loans 101. So some of those topics include student loan servicers. What are they and what role do they play in your student loans? The different types of federal student loans out there. This is a really important one because the type of federal student loan you have is going to impact your eligibility for certain repayment and forgiveness programs. So we'll talk about more on that in just a second. We're also going to talk about income-driven repayment plans. These can be a powerful way to help lower your monthly payment. And we're going to wrap it up by talking about public service loan forgiveness, or PSLF. This is one of the biggest and longest standing forgiveness programs out there that can forgive the remainder of your loan balance after 10 years in public service. So we'll go into more detail on that as well. All right, so let's kick things off with student loan servicers. So I put some examples of these companies on your screen right here. Great Lakes, Ed Financial, Advantage, Nelnet, OSLA, Mohila. These are companies that are contracted by the Department of Education in the repayment and management of your student loan. So when you take out a federal student loan and that federal student loan goes into repayment for the first time, you are assigned to one of these companies. You don't have a say in the matter, okay? And that's who is going to send you communication regarding your first bill, right? Your monthly statements, et cetera. So these companies are really in charge of collecting, right, on your student loan debt for the Department of Education. So again, you're assigned to one of these companies. They will send you a communication on how to create your online account with that company. That's where you will go to see, your monthly bill, to set up things like an auto debit, managing on a sort of month-to-month basis your student loan repayment, right? Now, something I just want to clarify is that Savi, okay, our company that's providing you this benefit, is not a servicer. We would never take the place of one of these companies you see on your screen right here, meaning you would never start making your monthly payments to Savi. Your loans would never move to Savi, okay? You can kind of think of Savi almost like an intermediary or a facilitator or an advocate on your behalf. So if borrowers are on one side and servicers are on the other, Savi's right in the middle. And our goal is really to reduce the friction that many borrowers experience with their servicers, whether that be they attempt to try and call to get an answer to their question and can't get a hold of a human being, are on hold for hours or more, or not getting the right information. Or maybe they're attempting to enroll in a repayment program and have submitted an application and have never heard back and aren't sure what's going on. There are all these touch points that a borrower may have with their servicer in which the outcome may be a negative one for the borrower to no fault of their own. And again, Savi is here to help ensure that that borrower, you all, is going to end up reaching that best outcome every step of the way. Now, a few things I want to mention about these servicers. First of all, it is completely normal for your servicer to change, okay, over the course or the, sort of the lifetime of your repayment, right? The reason being is because these companies are on contract with the federal government, and those contracts end. And when they end, they are not always renewed. And so what that means is if a company is on contract and that contract comes to an end, any of the borrowers that were being serviced by that company will need to be moved to a new or different servicer for management, okay? So it's completely normal if your loans end up moving 2, 3, maybe even more times, again, during the lifetime of your repayment as a result of this process, right? Nothing changes about your loans, the terms and conditions, everything remains the same. It is purely an administrative aspect of this in which you will now have a new servicer and you'll have to create a new online account to manage those loans going forward, right? But as a result of this, I want to point a couple things out. This means that borrowers oftentimes are having their loans moved. Again, they have no say in the matter and are unaware that this is happening. So a lot of movement has occurred in the last couple of years, especially during the payment pause during the COVID pandemic. So it's a good idea to just make sure you know right now, as of today, what servicer you have. And there's one place and one place only that you can go to find that information out. And that is studentaid.gov. I'm going to put this link in the chat right here. Studentaid.gov is the official website of the Department of Education. When you took out your federal student loans at the very beginning, you created what's called a federal student aid ID, or your FSA ID. You're going to use that to log in at studentaid.gov, and there you will see any and all federal loans and or grants you have ever received. And on that dashboard, it will tell you what servicer you've been assigned, okay? So that's where you can go to check that information. Now, once you know or have confirmed, again, what servicer you have, you need to make sure that your contact information is fully updated with that servicer, because that's the primary way they're going to be communicating with you about some important things like your due date and how much that monthly payment needs to be, right? And oftentimes borrowers' contact information may be out of date, all right? So again, it's a good idea to make sure that your contact info is fully updated and you've selected those preferences for communication, whether you want to go paperless, right, or receive paper statements. All of those things you want to make sure that you have taken care of so that, again, you have full and open communication lines with that servicer. All right, let's see. Any questions on servicers that I can answer before we move on to the next topic? All right, doesn't look like it. Okay, we're going to keep chugging along here. All right, next up, we are going to talk about the different types of federal student loans. And again, this is a really important one, something I myself as a borrower did not know about until I started working with Savi and became a student loan expert. And I want to emphasize this because of the fact that it has such an impact on your eligibility. And many borrowers often remain completely unaware of the specific loan type that they have and miss out on taking certain actions that could make them eligible and ultimately receive forgiveness. So I'm going to talk through the 3 different types of federal student loans in the green columns here. And then I'm going to touch on private loans at the very end. So let's start at the furthest left-hand side of your screen with direct loans. So the direct loan program is a federal loan program that began around 2010. So if you have a federal student loan that was dispersed to you from 2010 to present day, there's a very good chance it is a direct loan, okay? The easiest way to tell if it's a direct loan is it will literally say the word direct or DL, which stands for direct loan, in that loan title. Examples include direct subsidized, direct unsubsidized, and even direct consolidation loans. Again, if you see that word direct or DL, that's a direct loan. Now, the great thing about direct loans, okay, seeing as they are the most recent of the federal loan programs, is that they are eligible for all the programs we're going to talk about here today, including things like income-driven repayment and public service loan forgiveness. So if you have direct loans, you're good to go. Now let's move on to FFEL loans that you see here in red, FFEL loans, which stands for Federal Family Education Loans. Now, this was simply the federal loan program in existence prior to direct loans. So if you had a federal student loan dispersed to you before 2010, there is a very good chance it is a FFEL loan. The easiest way to tell if it's a FFEL loan is it will say FFEL or FFELP in that loan title. That P just stands for program, but that's a FFEL loan, okay? Examples include FFEL subsidized, FFEL unsubsidized, and even FFEL consolidation, okay? Now, here's the thing about these FFEL loans. In order to become eligible for programs like public service loan forgiveness, they will need to be consolidated into what's called a direct consolidation loan in order to be eligible. So the FFEL loan program, seeing as it is the older federal loan program, and new FFEL loans are no longer being issued. They stopped being issued in 2010, all right? So in order to be eligible to qualify for certain programs, mainly public service loan forgiveness, if you have a FFEL loan, you will need to take a corrective action, and that corrective action is consolidating that loan into what's called a direct consolidation loan, at which point it will be eligible because it's now a direct loan. Okay, so it's really sort of almost a technical or administrative hurdle that you need to overcome in order to make that loan eligible. Right? Now, consolidation is a free federal process by which you are basically consolidating one loan or multiple loans into a new direct consolidation loan. Okay, and the primary reason to consolidate is just this. It's because you have an older loan type that may not be eligible and you're trying to make it eligible, okay? It is not to be confused with refinancing, all right? Refinancing would be essentially refinancing a loan or a federal loan at a lower interest rate. And by doing that, you are turning that federal loan private, okay? That is not what consolidation is. Consolidation, again, is part of the federal loan system and process, does not check credit or anything like that, does not lower your interest rate. What it does is it makes your interest rates a weighted average of the loans that are being consolidated. And again, it remains, your loans remain within the federal system, okay? But that consolidation process is something that Savi can help you to do if you should need to do so. And we'll touch on that a little bit later on when I show you how the Savi tool works and how you can take advantage of that. Okay, now moving on to PLUS loans. So PLUS loans come in two varieties, Parent PLUS loan and Grad PLUS loan. So let's start with Parent PLUS loans. You know, many people think the student debt crisis is a young person's problem, a millennial issue, when in fact, the fastest growing demographic of student loan borrowers is actually ages 50 plus. It is parents taking out loans for their kids. And that's exactly what a Parent PLUS loan is. It's a loan taken out by a parent on behalf of a child, but in the parent's name. And that loan cannot be moved or transferred to the child. It is in the parent's name in perpetuity. All right. It might as well have been the parent's own student loan debt because that's exactly how it acts and operates. Right. Now, just curious, maybe by a show of hands, how many of you on today's session have Parent PLUS loans? Yep, quite a bit. Again, as I mentioned, this is the fastest growing demographic of student loan borrowers, which shocks many people because they think, you know, it would be new college grads. And in fact, it's not. Now, when it comes to these Parent PLUS loans, as you see there, right? Just like the FFEL loans I just talked about, Parent PLUS loans require that corrective action of consolidation in order to become eligible for things like public service loan forgiveness and even income-driven repayment plans. So if you have a Parent PLUS loan, you will need to consolidate that loan in order to be eligible for either of those programs and options. Right? Now, Grad PLUS loans, as the name might imply, are loans given to graduate and professional students. And the good news here is that they are eligible as is for these programs. They require no corrective action, okay? So if at this point you're already starting to think, all right, that was a lot of acronyms, a lot of information, I'm already a little confused, you'd be absolutely right. It just goes to show you how complicated the system can be. But here are the really important takeaways. Number one, knowing what loan type you have. And number two, if you have a loan type that requires corrective action in order to be eligible for certain programs, you're going to want to take that as soon as possible. So if you have direct loans, Grab Plus loans, you're good to go. If you have a FFEL loan or Parent Plus loans, and you are interested in pursuing programs like public service loan forgiveness or even income-driven repayment, you will need to consolidate those loans into a direct consolidation loan in order to make them eligible, right? Okay, last but not least, I just want to touch briefly on private loans. So of all the student debt out there, about 1.7 trillion, right? 90% of it is federal. So only about 10% are private loans. However, many borrowers often have a combination of both federal and private because they will take out private loans after they've exhausted their federal options, myself included. So private loans are obviously non-federal loans made or issued by a commercial lender, such as a bank, credit union, state agency, or maybe even your school or university. So some examples include Wells Fargo, SoFi, Discover, Chase, things like that. Now, when it comes to private loans, unfortunately, they are not eligible for any federal repayment, forgiveness, or relief programs out there. And there is no corrective action like a consolidation that you can take to make them eligible. Once they are private in perpetuity. Okay, there's no changing that. That being said, when it comes to private loans, if you are struggling to make those payments, okay, the best thing that you can do and the best place to find out what your options may be is going to be reaching out to that lender directly. Because each lender is going to offer its own types of repayment, assistance, et cetera, because there's no federal system under which those lenders must abide, right? So each one's going to be different, have its own rates, terms, et cetera. So again, the best source for that information and what options that you have when it comes to your private loans is going to be reaching out to your private lender directly. And again, this is something that Savi can assist you with in having that conversation and making sure we explore all of your options, right? And we'll show you how to do that towards the end of the presentation. All right, let's take a quick peek at the Q&A before we move on and see if there are any questions on loan types. All right, it looks like Job and Khadijah are busy answering questions. I appreciate you guys. So we will keep chugging along here and let them do their thing. Okay, now we're going to talk about income-driven repayment plans, or IDR, right? Again, these can be a powerful way to help lower your monthly payment. Before I go further, let me take a step back and give some basic context as to how repayment on your federal student loan works in general. So when you take out federal student loans, right, and they go into repayment for the first time, you are assigned to one of those servicing companies that we mentioned on the first screen. You have a 6-month grace period, all right, before you have to make your first payment, okay? And they'll send you that first bill amount. And oftentimes borrowers, when they open that up, are shocked to see how high that amount is. And that's because every single federal student loan borrower, when they go into repayment for the first time, is automatically put onto what's called the standard repayment plan. And this standard repayment plan calculates your monthly payment on two things and two things alone: how much student debt you have and a payoff timeline of 10 years. Okay, so I'll use myself as an example. With a little over $200,000 in student loan debt and paying that off in 10 years, okay, my monthly payment came out to, I believe, somewhere between $1,800 and $2,000 a month, right? It's absurd. And most borrowers could not afford to make their monthly payments on the standard plan, especially since people have been taking out more and more student debt, higher student loan balances in the recent years, right? That means that those standard plan payments are only going up. So the Department of Education introduced what are called income-driven repayment plans. And instead of basing your monthly payment on how much student debt you have, these plans base your monthly payment on two different things: your income and your family size, okay? And what that does is for borrowers who have an especially high debt to income ratio, it significantly reduces that monthly payment. You could have $500,000 in student loan debt. It wouldn't matter. If you're making less than, let's say, $30,000 a year, you could qualify for as low as a $0 monthly payment. Right? So I'm going to explain more on how these work in just a second. But first, I want to make sure that everyone's aware of sort of the structure of the income-driven repayment program. So income-driven repayment, or IDR, is sort of the umbrella descriptor term here, okay? And then there are 4 types of IDR plans. There's the SAVE plan, formerly known as Repay, which is the newest plan that was introduced last summer by the Biden administration, and the one that I'm sure many of you have been hearing about in the news because it has come under fire from some lawsuits, with the administration. We'll talk about that in a second. There's the PAY plan, which stands for Pay as you earn, IBR, which stands for Income-Based Repayment, and ICR, which stands for Income Contingent Repayment. Now, we're not going to go into the weeds on the differences between these 4 plans here today. A lot of it comes down to some technicalities around your loan type, disbursement date, things like that. The great thing about the Savi tool that we'll show you later on is that it's going to be able to identify for you which one is going to be best based on your personalized eligibility. All right, so you won't have to worry about digging through that on your own. But I think it's just helpful to understand that there are 4 different IDR plans, but they all generally work the same way. They cap your monthly payment at anywhere between 5 to 20% of your discretionary income, depending on the plan. What is discretionary income? Well, part of your income is set aside to cover the cost of living, and that leftover amount is called discretionary income. And this is what your monthly payment is based on. So really, they're looking at your adjusted gross income, or AGI. Okay, so this is going to be pre-taxed income. I'll give you an example. Let's say you are single with no dependents and an income of around $52,000 a year. On an income-driven plan, that's going to come out to around $160 a month. Now, for every child dependent that you have, that's going to lower that monthly payment by about $50 per child. Even unborn child dependents count as well. Okay. It also is going to factor in your tax filing status when it comes to how it determines your income. If you file your taxes as single, it will look at just your income. If you are married filing jointly, it will look at your joint combined income. Even though your spouse may not have student loan debt, all right, if you are married filing jointly, it will look at the joint income when it calculates your payment amount for an IDR plan. And if you are married filing separately, it will look at just your income alone, okay? So something to just be aware of and to consider, again, when looking into these programs. Now, if your income is low enough, you could qualify for as low as a $0 monthly payment, okay? And there is no cap or income cap as far as how high your income can get. So you could be making $300,000 a year and qualify for an income-driven repayment plan. Again, it would just mean that you are paying more based on your income, okay? Now, how do you enroll in an income-driven repayment plan? Well, because you are automatically put onto the standard plan, right? In order to change into one of these income-driven plans, you need to submit an application. And that application requires you to attach supporting documentation attesting to your income. This can come in either the form of your most recent tax return or a pay stub from the last 90 days. Okay? If you have no income or are unemployed, you do not need to submit any documentation. In fact, you can basically self-attest to no income. Now, that application and documentation gets submitted to your servicer, Mohila, Nelnet, whichever one you may have. That servicer reviews it and says, okay, Lindsay, you'll be put on the SAVE plan and your monthly payment will be $160 a month. And it locks in that amount for 12 months. 12 months comes and goes, and you have what's called a recertification deadline. And in order to maintain yourself in the program, okay, you need to resubmit an application with updated income documentation, okay? And your servicer will essentially repeat that same process, review it and say, okay, Lindsay, Again, you're on Save, and for the next 12 months, you'll be paying $180 a month, right? The implication being, based on any fluctuations in your income or family size, up or down, your payment amount may increase or decrease from year to year, okay? So that's just something to keep in mind. Now, if you miss that recertification deadline, what happens? Well, you fall out of the program, which means your next month's payment is going to go right back to that standard plan amount, okay, which is for most borrowers a lot higher than their monthly payment on an income-driven repayment plan. So one of the things that Savi helps borrowers with is to ensure that about 2 months out from that recertification date, that we are preparing your application and documentation. That way there is a smooth transition to keep you in the program. You are aware of any changes in that payment amount, and you are all set without any disruptions to continue on track in that particular income-driven plan. Another thing to note about these income-driven repayment plans is that you are eligible to have the remaining balance forgiven on those loans after 20 to 25 years worth of payments, depending on the plan. And because these plans forgive remaining balances, the implication is that the less you pay during that time, the more you get forgiven. So on an income-driven repayment plan, the goal is not to try to pay off your loans as quickly as possible or pay as much as possible each month. In fact, it's the opposite. The goal is to minimize your monthly payment with the expectation that you are actually maximizing your forgiveness, right? Now, another thing to note here is that the forgiveness on income-driven repayment plans is tax-free at the federal level until 2025. However, after 2025, unless there is an extension from Congress, that forgiveness that you could receive would be considered taxable income, all right, at the federal level. So just something to note, although that could be extended. And again, we will communicate with any borrowers about that extension when the time comes. Now, how long you pay for depends on a few factors, like which IDR plan you're enrolled in and your loan type. So here you can see, based on the 4 different IDR plans, what that timeline looks like. On Save, it's 20 years if you have undergrad loans, 25 years if you have grad loans. On the Pay plan, it's 20 years. On IBR, it's 20 years if you borrowed after 2014, 25 years if you borrowed before. And on ICR, it's 25 years. No application is needed to receive this forgiveness when you end up reaching that point. It's done automatically after you've been in repayment for that period of time, okay? And again, when it comes to understanding and determining what this forgiveness on an income-driven plan looks like for you, the great thing, again, about the Savi tool that we're going to show you later on is that we're going to be able to outline for you, down to the year and month, what that timeline looks like, all right, and how far you are away from potentially receiving it. The last thing I want to note related to income-driven repayment plans has to do with some of the more recent and major policy updates. Again, I'm sure many of you may have been hearing about Save in the news, and there's a reason for that. So the Save plan, again, is the newest income-driven repayment plan, okay, that was introduced by the Biden administration last year. And it was supposed to be the most affordable income-driven repayment plan to date. It was going to ensure the lowest potential monthly payment based on how it was going to calculate your income and a few other things. So that plan went into effect last summer. And then this past July 1 of this year, another wave of improvements to the plan were supposed to go into effect. More specifically, they were going to reduce the percentage of discretionary income for undergrad borrowers to 5% of their income, right? So that would basically cut payments further in half for borrowers who enrolled in the program. And then the other element that was scheduled to go into effect in July was that borrowers with lower original balances, less than $12,000 in total, would be eligible to qualify for a shortened timeline to forgiveness. So instead of having to wait 20 years, they'd be eligible starting at 10 years. However, lawsuits were filed, okay, over the summer that put these changes on hold. And as a result of a July 18th ruling by a federal court, the entire SAVE plan has been put on hold as of today. Now, what does that actually mean for you and other borrowers? So here's what has occurred as a result. Anyone already enrolled in SAVE, okay, as of these lawsuits and when it went into holding, was placed in an interest-free forbearance, meaning they were not going to accumulate interest and would not have to make a payment, okay? And anyone who attempts to enroll in the program now, and yes, you can still enroll in SAVE and submit an application. However, you will also be put into what's called a processing forbearance while they attempt to figure out, what they're going to do with this program. Okay, so you can still submit an application to try to get into SAVE, but you will go into a forbearance as well. Okay. Now, as a result of what's happened with SAVE, this has impacted enrollment in income-driven repayment plans across the board. So those other plans like Pay, IBR, ICR, borrowers trying to get into a plan, within the last couple of months, have seen that there is a tremendous processing delay from the servicers on all of those applications. And in fact, for periods of time, the servicers have paused processing IDR applications entirely. You also are not able to apply online through studentaid.gov to enroll in these programs. Normally, before these lawsuits and SAVE was put on hold, at studentaid.gov, you could go through their tool, answer some questions, and actually get enrolled in any one of those plans via your studentaid.gov account. Since the SAVE plan has been put on hold, they have removed that option. The only way to enroll in an income-driven repayment plan, whether it's SAVE or any of the others, is by submitting a paper application. Okay, now, the great thing about what Savi does and how our tool operates and works is that we have always used and submitted paper applications on behalf of borrowers. We pre-fill and digitize them, but they are not done through the studentaid.gov system, which means we are probably one of the only places that can still support anyone trying to enroll in an income-driven repayment plan. Otherwise, you will have to print that form and mail it into your servicer, which I know many borrowers are suspicious of that actually even reaching where it's supposed to reach. Right? But all the other IDR plans, Pay, IBR, ICR, again, are still available to enroll, but you should expect tremendous processing delays, upwards of months. And it's looking like the SAVE plan, at least those already enrolled, will remain on this forbearance for at least another 6 months. We are unlikely to hear any updates on the future of this program before the end of the year, unfortunately. But if we do hear anything or anything changes that would impact your eligibility or the need to take action, again, the great value of having a Savi account is that we will communicate that to you right away. Right, we're sort of your trusted go-to source for anything and everything that you may need to know or take action around your student loans. Okay, let's see here. I know some questions were coming through. Job, is there anything related to SAVE or IDR that might be helpful to answer out loud before we move on and talk about public service loan forgiveness?
For sure. So let me take a quick look at the Q&A. I do remember one question. Someone was asking how the SAVE forbearance impacts their progress towards forgiveness programs.
Yep. So this is a great question. So if you have been placed into that forbearance as a result of being enrolled in SAVE, unfortunately, as of right now, the Department of Education has indicated that these months of forbearance do not count as progress towards public service loan forgiveness or even income-driven repayment forgiveness because of the fact that the program itself is on hold. And so any payment forbearance or any type of status within that program simply cannot count because it's not able to move forward at this time in its current state. That being said, the Department of Education is aware that this is to no fault of borrowers, that you are all placed into this without your consent, essentially, but have no choice in the matter. And even if you wanted to or attempted to make a voluntary payment during this forbearance period on your loans, it would not count towards PSLF or IDR forgiveness, again, because it wouldn't register that payment as part of SAVE or any IDR plan. So with that said, for those that are trying to pursue, especially public service loan forgiveness, and are maybe even close to reaching that finish line and every month counts, there is something called PSLF buyback. And I will have one of my colleagues maybe put a link to an explanation of this from the Department of Education in the chat, because it's a bit intensive. But essentially, this program allows someone trying to pursue public service loan forgiveness to buy back certain months or periods of time during which they did not either make a payment or maybe were in a forbearance status, such as this one, that did not count. So using this period as an example, if you were to utilize that buyback, what would happen is you would basically be able to buy back credit for these months in forbearance, and that amount would be equal to whatever amount you were paying on that SAVE plan for that month. So let's say you qualified for a $0 payment on SAVE, right, during this time, but you're in this forbearance. To buy that back, you would pay $0. Okay, so whatever the amount that you were supposed to be paying that month on that plan, right? So there will be some options, again, especially for those that are looking to pursue public service loan forgiveness and wanting each of these months to count. However, the department realizes that, again, this is not something that borrowers, should be penalized for, and not getting credit to move forward. And so I'm hopeful and optimistic that they will come to sort of some resolution, or will come up with something that can help maybe change that going forward and be able to give borrowers credit for these months. But as of right now, technically, no, they do not count if you've been put in that automatic forbearance. All right, I know Job and Khadijah are continuing to answer those questions. So we've got one more topic to cover before we sort of transition and talk about how Savi can help you to tackle all of these things. And that is public service loan forgiveness, or PSLF. PSLF is essentially full forgiveness on the remainder of your loan balance, whatever that may be. It could be $5,000, it could be $500,000. Doesn't matter. Tax-free, so there are no federal tax implications here now or ever. All right, so that's different than income-driven repayment forgiveness, right? This public service loan forgiveness, since it was signed into law, there will never be tax implications after you have made 120 qualifying payments. Now, if you could see me on camera right now, you'd see that I'm saying qualifying payments in major air quotes, because the devil is really in the details as to what constitutes a qualifying payment. And it really comes down to three things. And these three things that you see on your screen right here, that you have to satisfy simultaneously. Number one, you need to work for a qualifying employer. This is any government organization at any level, federal, state, local, or tribal, or any non-for-profit 501c3. The only stipulation here is that you must work a minimum of 30 hours or more on average per week, right? However, I want to clarify, it does not matter in what capacity you work, your role, title, etc. Okay, you could be janitorial, administrative, whatever. All that matters to qualify is the employer on your W-2, okay, not your particular role within that organization, right? Another thing to note is that you can combine multiple or part-time employment to qualify, so long as all the employers are eligible. So you don't just need to be full-time at one qualifying employer in order to be eligible. You can combine, again, part-time or multiple employment, so long as combined that's 30 hours or more a week, and the employers that you are combining employment from are all qualifying and eligible employers. Right? Lastly, on employment, This program is retroactive going back to October 2007. Why October 2007? Well, that's when it was signed into law, which means any qualifying employment that you've had from October 2007 to present day is fair game as far as qualifying for this program. And oftentimes borrowers have worked for 3, 4, or 5 plus different employers over the course of their career. Again, all of those can count going back to October 2007. Unfortunately, any employment prior to October 2007 does not qualify or count for the purposes of this program. The clock starts October 2007. Okay, so that was number one, qualifying employment. Number two, you have to have a qualifying loan type. And the only type of federal loan that qualifies are direct federal loans, okay? Again, that's why I emphasized loan type so much earlier in the presentation. If you have a non-direct loan, like a FFEL loan or a Parent Plus loan, you will need to consolidate that loan into a direct loan in order to qualify, okay? So again, we talked a lot about this earlier on, but that is the second part of this PSLF program is your loan type. And then number three, you need to be repaying that loan on a qualifying repayment plan. And the only types of repayment plans that qualify are income-driven repayment plans. It can be any one of those four, doesn't matter which one, just needs to be one of them. And you need to make that payment for the on-time and full monthly amount. So you need to satisfy all three of these things simultaneously, okay? And you need to make 120 of these payments, right, in order to achieve forgiveness, okay? Now, a few things that I just want to clarify, a few common misconceptions about these 120 qualifying payments. The first is they do not need to be made consecutively. You just need to reach 120 total cumulative qualifying payments. So let's say you worked for a qualifying employer for 2 years, making consistent payments during that time with a direct loan and on an income-driven repayment plan. And you were able to qualify for 24, qualifying PSLF credits. And then you left and went to go work in the private sector, an employer that didn't qualify. Nothing happens to those credits that you had received. They simply pause. And if you were to ever resume working for a qualifying employer, it doesn't have to be the same one. It can be any qualifying employer. You can resume accumulating those credits.
Hi, everyone. So sorry for the technical difficulty. We are going to get back up and running in just a moment. Once again, for all of you that are rejoining, apologies for that. We are getting back up and running, and we are very sorry for the technical difficulties. Our presenter, Lindsay, is still rejoining. Again, we're very, very sorry for that, but we are going to be back on track in just a moment. Just to answer a couple quick questions in the Q&A, because of this technical difficulty, we are recording this. We will get you with that recording link later. So if you're still experiencing any technical difficulties, you'll have that recording where you can go back and see it all there in case you miss anything. While we're waiting for Lindsay to join, a couple other quick questions in the Q&A, and we'll talk more about this soon, but I see someone asking, who can I talk to about some of these issues I'm having, and why is it that sometimes my servicer tells me one thing, but Savi recommends something different? And again, this highlights why Savi is here, is because there is so much information to take in. There is, so much confusion, and sometimes even the servicers will make mistakes. But we are here to support you, make sure you're getting your best outcome. So if you have questions about your situation, or if you are needing help resolving an issue with your servicer, again, that's exactly what Savi is here to help with. And we're going to show you exactly how you can get started with Savi and contact our support team for assistance coming up soon.
All right. Thank you, Job. Everyone, I am so sorry. My computer and Zoom completely shut down right in the middle of our presentation. So I apologize for the technical difficulties, but appreciate you all hanging around. And we are back up in action. And thank you, Job and Khadijah, for taking over. So just really quickly to wrap things up on public service loan forgiveness, as I was saying before things went dark, you just need to reach 120 total cumulative qualifying payments. However, I want to clarify that you can only receive one qualifying payment credit per one payment per one calendar month. Okay, meaning you can't double up on payments in a month and get double the amount of credits, and you can't make a huge lump sum payment and get more credits than you normally would. The easiest way to think about it is this: in any given calendar year of 12 months, the maximum amount of PSLF credits you can receive is 12. So if you have to get to 120 total, right, you can only get 12 a year. You are all very smart and can do the math there. That's 10 years minimum before you'd be eligible to receive forgiveness under this program. And that would be if you were making the payments consecutively, which again, you don't have to. So for many people, it may take them more than 10 years to achieve forgiveness under PSLF. So while many people describe this as a 10-year program, I discourage you from doing that because it sort of falsely makes it seem like it's just about your time served in public service, when in fact, qualifying for forgiveness under this program comes down to not 10 years served, but 120 of these qualifying payments. That is what is going to determine your eligibility and when you've reached that finish line. So just want to make sure that everyone's aware of that. Now, how do you apply for public service loan forgiveness? Well, there's one form and one form only. It's called the PSLF Employment Certification Form. This form gets signed off by you, the borrower, and then it needs to get signed off by your employer, any current or previous employers you might have had. If you've worked for 4 total qualifying employers over your career, let's say 3 previous and 1 current, that means you're going to need to submit 4 total employment certification forms, 1 for each of those employers. Okay. That employer, usually it's someone in HR or who has access to your employment records, will sign off on that form, attesting to the fact that they are an eligible employer, your dates of employment, or if you're still working there, your average hours, right, per week. And then they will sign off. And then that form needs to get submitted to the Department of Education, which will review it and will award you those qualifying credits. Okay. And that will really be the determination of where you are, in the process towards that 120. And when it comes to these employment certification forms, this is, again, something that Savi can help you to basically get enrolled, submit on your behalf, and then to monitor that entire process from start to finish for you. Okay, so at this point, we're going to transition. I know that was a lot of information that we just talked about, but the good news here is that you all have access to this incredible Savi benefit that is designed to help be with you every step of the way as you leave today and go forward around your student loans. Because I know firsthand, as I mentioned, that all of these programs, while seemingly great, and they are, we are seeing more borrowers than ever get their loans forgiven. They can be overwhelming and can often leave you feeling lost, unsure of which plan and option is best for you, unsure of what that path forward looks like, and if you're doing everything you need to. And that's exactly where Savi comes in, to really help illuminate that best path forward for you personally. Not every student loan borrower, but you personally. So as you're going to see in a second here, we're going to ask you some basic questions to be able to collect the information we need to show you a personalized forgiveness and repayment plan. I mean, down to the cent as to what you'd be eligible for on a monthly payment wise, and down to the year and month as to how far along you are towards forgiveness. We also monitor for new programs and policy changes. So everything happening with the Save Law student, anything else in the world of student loans, you can count on the fact that Savi is not only going to communicate with you as to any important news and things you may need to take action on, but your Savi account will always include and feature the most up-to-date information and options for you. And then we take it a step further. All right. We not only show you what that best path forward could be, but given we know what an heavy and hard administrative burden these programs and getting enrolled in these programs can be, we have offered you all the option to have Savi take on that burden for you, okay, and process any and all of the paper and applications that you will need to enroll in any of these repayment and forgiveness programs. We pre-fill, digitize, and submit these forms on your behalf, and it removes any and all human error. And we monitor those applications to ensure they achieve the desired outcome. I'm sure many of you have had experiences in trying to enroll in these programs and submit applications, only to find you get rejected and are not sure why. Or maybe you submitted an application and never heard anything for months on end. And that is actually a normal experience for student loan borrowers. Okay. And that's really why Savi exists, is to come in and to help alleviate that pain point in the process. And the best part of all is that these premium plans offer you the ability to receive one-on-one support from student loan experts. These are real life people, as you can see on this session here today. Job, Khadijah, and we were just joined by Katie Kashmir, who has been working tirelessly with borrowers from the AARP community for the last several years. Many of you may know her by name. These are actually the folks that you will be working with and have access to through your Savi account to have those conversations, to be that touch point at any point along the way as you embark going forward. And the best part is that we use technology, okay, not to make things harder or more difficult, but to simplify the process. So instead of having to fill out all of these different applications on your own, we collect the information we need in one application for you. We call our Savi application, from which we are then able to show you your options and pre-fill every application on your behalf, right? So we really try to make the process streamlined and easier for you, the borrower, to navigate. So to get started and sign up for Savi and access that benefit, you can go to aarp.org/student loans. And my colleagues will put this link in the chat as well for easy access. And all of you on today's session who registered and who have attended, you will receive an email, all right, following today's session that will give you access to this account. So if you want to just, follow along for right now, I'm going to walk you through a few screens, about the Savi account to give you a look and feel of what you can expect. And you will receive all the information you need to get started following today's session via email. So again, to register and get started, you'll need to go through your AARP account because this is an exclusive benefit that access is given through AARP. So when you go to that link or that page, you can either log into your AARP account, okay, from there, or if you are not a member yet, you can easily become a member right from that page as well. Now, once you've done that, you'll be brought over to your new Savi account. And this is sort of, again, going to just give you a look and feel of what this experience is like. You can kind of think of it almost like a TurboTax for your student loans, or at least that's the best analogy I can use to describe it. We're going to ask you some basic questions around your family, marital status, dependents, right? We talked earlier about how these things factor into calculating your monthly payment amount on an income-driven plan. We're going to ask about your income and employment. This employment section is important in helping us determine your eligibility for certain forgiveness programs, like a public service loan forgiveness. So if you are currently employed, I highly encourage you to add not only your current employer, but any previous employers you may have had, because again, these programs are retroactive. This will help give us a better idea of exactly what your eligibility looks like. If you are not employed right now, simply type NA in the employer name and you'll be able to then proceed from there. All right, after you've entered in that employment information, you'll just need to register your Savi account officially so that we can save all of the information that you've entered thus far, and we can proceed in collecting even more. And the last step in the process is linking your federal and private student loans. We provide a couple of different options on how to do this. You can either sync them via our loan sync, where you can enter your phone number and date of birth, and it will pull in that loan information from your servicer. Or you can add the loans manually, or you can upload your student loan data from your studentaid.gov account. And all of those options you'll see there with explanations and instructions on how to do so. This is important because those data points, your balance, interest rate, loan type, right, disbursement date, those are all very important in helping us determine exactly what your eligibility looks like and making sure that we are giving you the best estimates possible. And once you've done that, that's it. You reach the end here, which we call our plan options page. And this is where we show you exactly what those best options could be. So you'll see here, this is a borrower who is eligible for the SAVE income-driven plan. They see what their new monthly payment amount would be, what that total payment over time looks like, so how much they would have paid in total by the time their loans are done, how long until they'd be eligible for forgiveness, down to the year and month, as you can see, and how much in forgiveness they'd be eligible to receive. They can expand below for more details and compare this plan to what they'd pay on the standard repayment plan. They'll also see, if eligible, other income-driven repayment plans and what those monthly payment and options look like. So all that information is presented to you here, completely personalized based on your information and your student loan situation. And it's at this point where the next steps for you, the borrower, are going to be submitting those applications and documentation to get yourself enrolled and on track, whether it's for income-driven repayment and or public service loan forgiveness. And this is where we offer you the option to either continue on for free under our DIY plan, and you will be responsible for submitting those forms and applications on your own. So we will send you instructions in the paperwork on how to do that, but you will manage and monitor that process on your own. Or you have the option to upgrade to one of our premium services. Our most popular and common is the Essential that you see right here in the middle. And this allows you to have Savi take on all of the application, enrollment, and monitoring for you. So your income-driven repayment plan, your public service loan forgiveness applications, we do all of that on your behalf. We monitor it to ensure it achieves the desired outcome. And you get access to one-on-one support with our student loan expert team. You are able to initiate that conversation right from your Savi account at any point in time, and you're able to call our support team as well whenever you need them. And that's part of our Essential plan, where we really do the heavy lifting, okay? And that comes at a reduced rate of $75 a year. Or we offer the Pro level. This is sort of our highest tier of premium service. Kind of think of it like a concierge support, and that is at $175 a year. But this gives you the ability to actually have a one-on-one sort of hour-long session with a student loan expert that you can schedule at any point in time that you'd like, right from your Savi account. And this person is your dedicated concierge through your student loan experience. They're going to walk you through all of your situation and answer any and all questions. And they are going to make sure that all of the paperwork, et cetera, everything that you need is taken care of. So if you're someone who maybe is a little bit less adept with technology, and you're really looking to just kind of sit down and have a personal conversation, or someone is, able to walk things through, and you're asking questions, and they're going to really do most of that for you and setting that up, then the pro plan is the way to go. But it's completely up to you. And again, every borrower can always continue for free under the DIY. And that's where, again, you would be responsible for submitting all the forms that you need to. Just to give you a sense of what those premium plans look like. So on the left here, you can see this is someone who is eligible for public service loan forgiveness and has 3 qualifying periods of employment. That means they need to submit 3 of those employment certification forms. With the click of a button right here, okay, we are going to pre-fill and digitize that form, send it to the borrower to sign off, and then we actually send it out to their employers for them to collect those signatures. So we manage and monitor the process start to finish, end to end. That borrower literally does not have to lift a finger, communicate with any employer or whatnot. We manage it all. And then on the right here, you can see this is an example of a pre-filled income-driven repayment plan. Again, through that essential membership, a borrower is able to, even right from their phone, access that application, sign off electronically, attach any documentation, and we submit it to their servicer on their behalf. And then whenever they log into their Savi account, they can manage and monitor any of their active applications and what they may need to do right from their Savi dashboard. This is sort of like mission control for everything Savi. And it's where we monitor all of those applications in progress to ensure, again, that they achieve the desired outcome. So you can see here on the left, this is that same person with 3 different employment certification forms, as well as their income-driven repayment application. And on the right here, zoomed in, they'll see exactly where they are in the process, what's been submitted to them, what's been submitted to their servicer, where they are, what we might still need to do, estimated wait time, right? This provides a level of visibility and transparency into the process that I found as a borrower almost impossible to achieve in working directly with my servicer. I'm unable to even get a hold of a human who can tell me what's going on with my application when I try to call. And oftentimes, if I've submitted applications in the past, I hear nothing for months on end. There's actually even no evidence that they received it. There's no confirmation that it was accepted, it's received. This all leads to borrowers wondering what's going on, what's happening with their application, whether or not they need to resubmit, right? Savi, again, by submitting through our tool, is able to manage and monitor all of those, I would say, anxiety points for you, right? To ensure that if there are any issues along the way, or if you receive a communication from your servicer that you're not sure what it means and why, Savi is your first go-to. And we're going to be able to not only make sure that you are protected and advocate for you, that we hold your servicer accountable, but that at the end of the day, again, we help you achieve the best outcome possible. And last but not least, that brings me to our amazing customer support team. This is an internal team of student loan experts that have been working with borrowers for several years. You can access them as part of those premium plans by clicking contact support from your Savi account. We have an incredibly helpful and detailed knowledge center or help center where all of these programs are explained. And then you are able to send a message and initiate that conversation with your dedicated agent right from your Savi account that you can see on your screen here. All right, so I know we are a few minutes over. I apologize, but just to recap, what's next? All right, you can get that free repayment and forgiveness eligibility review with Savi, right? As part of that DIY, enter in that information and see what your options are. And AARP members and their families can save up to $50 off of those Savi Essential and Savi Pro services, which again includes that customized, personalized one-on-one support. So make sure to go through your AARP account to get started with that process so that we can help you with your student loans as soon as possible.